Hi there, this is Dennis Wells with Wells Funding, and many people have been asking a lot of questions about forbearance and specifically how that relates to mortgages because of the CARES Act of 2020 that does give homeowners the option to go into forbearance with their mortgage payments as a result of being affected by the COVID-19 pandemic. And I want to make sure that everybody understands what this means and what the effects of this would be on the average homeowner. So I'm going to apologize up front for maybe getting a little nerdy and math heavy, but I think it's important to be able to see the options out there and really what forbearance is, what it means, and what you can do about it. We need to look at what is forbearance. Forbearance is simply pressing pause on the payments associated with your loan. And in this instance, it's on your mortgage, but student loans go in forbearance and those kinds of things are deferment. So we're kind of familiar with that. But even if your loan is in forbearance, the housing expenses related to your house continue. So there's still insurance payments that are due, taxes that are due, interest that accrues. Okay, so forbearance is not forgiveness. Okay, your obligated payments do not go away when you go into forbearance. Also, forbearance is not free money. A lot of people think, well, I'm just going to skip some payments. I can save the money. I can do something else with it down the road. It is also not a government bailout. The CARES Act provides really no money towards mortgage payments. Okay, so they've not set aside any money to make people's mortgage payments. It never entered the mind of people in Congress to actually make your mortgage payment. So it's not a government bailout to homeowners who have been affected negatively by the virus. Basically, forbearance, when you put a pause on the mortgage, there's going to be a restart. In fact, it has been said that it's not the fall that kills you, it is the sudden stop at the end. And when we look at forbearance, it's not the pause that kills you, but it is the restart. And every loan that goes into forbearance will be restarted at some point. And there's really only 3 ways that can happen. And there may be minor differences from one mortgage company to another, but those are going to be variations on one of these 3 options. The first option, which is the least likely, is to add the payments to the end of the loan. It's least likely because that's not forbearance, that's actually deferment. You're deferring your payment to some later time. The second way to restart the process is to recast the mortgage or to modify the loan. And the third and probably most likely way to restart the process is that all missed payments will be due at the time of restart. So to walk through those different options and put some numbers behind it to give you an idea of how that would work, I put together a tale of 2 homeowners. Maybe they're neighbors. They bought the same house, took out a $300,000 mortgage 5 years ago at 4% interest. They pay $300 a month for their taxes and homeowners insurance. One chooses to do the 12-month forbearance, one does not. Right now, before they make the forbearance for the one person, their current payment is $1,732, which is your principal, interest, taxes, and insurance on the mortgage, and the unpaid principal amount is, looks like $271,000. Now, we're familiar with this, that every time you make a payment on a loan, even though the payment amount stays the same, every payment reduces the principal balance, which also reduces the amount of the payment of future payments that goes to interest, because you're only charged interest on the money that you've actually borrowed, that you have out there. So every time you make your payment, the next payment has a little bit more principal, a little bit less interest, even though the final amount stays the same. So as you can see on this chart, as you walk down year by year, that unpaid principal balance goes down every year, and the amount that you're paying for interest goes down, and the amount that you're paying towards principal goes up year after year. But what happens to the loan when someone presses pause on it? Well, again, if you add the payment to the end of the loan, which is the most widely talked about scenario, even though it's the most unlikely way that it's going to work out, it still makes a big difference in your monthly payment, because at the end of the year when you restart, you still have to make double insurance payments, double tax payments. The servicer is probably going to assume that the taxes and insurance are going to increase. So just adding your extra unpaid escrows, taxes and insurance, to the monthly payment for the next year is going to result in your payment jumping up $300 a month. But what happens if, like most people, you don't want to pay your loan off in 30 to 31 years in this case, but you maybe want to sell it in year 8? Well, there's going to be a big difference in, borrower 1 who continued to make their payment and borrower 2 who went on forbearance. Assume they get 3% per year in appreciation. They both end up at $380,000. We're assuming 10% for cost to sell, which would include seller's concessions, closing costs, realtor fees, those kinds of things. It's a ballpark, it's not an exact science there. But then your principal balance is higher for the person who was on forbearance than the person who was not. So that person, nets less money when they sell their house than someone who did not go into forbearance. Also, it remains to be seen if there will be a waiting period before someone is able to get a new purchase mortgage after they've gone on forbearance, because we'll talk about that later on, but there's going to be some repercussions on your ability to refinance your mortgage or get a new mortgage if you've been in forbearance. So the next way, which is a little bit more likely than the first method of restarting the pause, is to take your missed payments, recast them, modify your loan, which basically means we take the principal balance at the beginning of forbearance, you add the unpaid interest for 12 months, now you have the new principal balance that you re-amortize over the remaining 24 years of the original loan term, which bumps up your principal and interest payment almost $100 a month. Add to that your additional escrow money, and your payment goes from $1,732 to $2,125. Again, that is going to be a significant, almost $400 a month increase, and that is not going to go away. That is going to be your new payment going forward through the life of the loan. The only thing able to change would be your taxes and insurance, and generally those items tend to go up in price as well. The most likely scenario in forbearance is going to be that all missed payments are due at the restart. And this is really why I wanted to put this video together and share with you just how scary this thought could really be. So borrower 1 at the end of forbearance, the one who did not go into the forbearance, is still paying $1,732 a month for their mortgage payment. Borrower 2, who took the 12 months off, will wake up at the end of that year owing $22,519. to catch his mortgage up. That is the 12 months of forbearance plus the current month that is due. And if that's not scary enough, you need to think about what else is going to be true at this time. Number one, regardless of how forbearance works, there's going to be no refinance option for people who take forbearance. It's very fluid. However, you can guarantee that there's probably going to be at least a requirement of 12 on-time payments before you can refinance your mortgage moving forward. So there's going to be no refinance option for the person that now finds themselves with a $22,000 payment to bring their mortgage current. Also, there's a high foreclosure risk, because by the time you get to the end of the forbearance, even if it's just a 6-month forbearance, you have already seasoned your loan for foreclosure. You've already been behind over 90 days, over 120 days, and foreclosure proceedings could start immediately. And then thirdly, credit will be affected. Just because the mortgage company cannot mark you as late paying on your mortgage when you're in forbearance doesn't mean that they can mark you as being paid on time. It will be noted in your credit report that the loan is in forbearance. It'll note when your last payment was, and I don't know exactly how the rest of it is going to look, but I do know that it will affect your ability to refinance and potentially purchase going forward. And here's what is the reason why I really wanted to share this is currently homeowners have an incredible amount of equity in their homes. In 2005, 6, and 7, right before the crash of 08, homeowners took $824 billion out of their homes. Sometimes they would refinance to 125% of the appraised value. They were using their homes like an ATM. They were buying boats and cars and going on vacations and doing crazy things like that, which was wrong. However, in 2017, 18, and 19, to compare, homeowners have taken only $232 billion out of their homes, which means that most homeowners are sitting on a great amount of equity right now that is jeopardized by doing the forbearance. Also, we have every reason to believe that housing prices will continue to increase even though we're likely in a recession right now. Why do we say that? Well, because if we get past 2008, which was caused by the housing industry, every other recession, when we look at them together, housing prices have gone up. Even in 1980 and 1981, when mortgage interest rates were close to 20%, houses gained 6%, 3.5% value. 2001, when we had the dot-com bust and 9/11, we had 6.6 increase in home values. So your home is an appreciating asset. You already have a lot of equity in the house. Don't jeopardize that by going into forbearance. A lot of people say, well, then what should I do? If I'm not going to go into forbearance, what should I do about this? First of all, you need to make and live by a family budget. A budget is just a spending plan. How are you going to spend your money? What you're going to prioritize, what you're going to invest your money in, and what you're not going to. Prioritize your house payment. Number one is food. You need food to live. Number two is shelter. You need to make your house payment. Negotiate with credit cards before skipping your house payment. Remember, this is temporary. The economy has only been shut down for 3 weeks at this point. And while it is terrible for those that have been affected and who are unable to work, this is only a temporary situation. This is not going to last forever. Also, I'm going to be hosting another webinar called 6 Steps to Financial Freedom, where you can learn how to make a family budget, where you can learn how to pay off your consumer debt, build wealth, how to leave a legacy. And there'll be a link to the webinar in the comment section below at the end of this Facebook Live as well. Thank you so much for your attendance here today. I really appreciate your attention. I wouldn't have spent the time to put this together or do this if I was not super concerned that there are many people that could be hurt badly through the forbearance options that are going to be offered to homeowners. If there's any way that you can make your payment, you need to keep doing that, even if that means, cutting back on some extras. Maybe it means, putting off paying some credit cards. You're much better to have late payments on your credit card and still have a roof over your head. When we get through all of this, and we will, there's going to be a great opportunity for people to, refinance their homes, lower their interest rate, get some cash out, pay off some debts. There's a lot of things that can be done when we get through it, as long as we're smart in the process. And at Wells Funding, our goal really is to help good people make great financial decisions. And so if you have any questions, concerns, or comments, feel free to leave them in the comment section below this. And we wish you the very best, and we'll be talking with you soon. Have a great day.